Hi, everyone. Good to see a lot of people already on time for the start of the webinar. That is always nice to see. Thank you for joining us here today, myself and Christopher here of WAD Capital. We're very excited to be talking about something that we're both very passionate about, and that's more technology, more data in private equity and in deal sourcing. Get strapped in. We're going to have a lot of fun here. All right. So maybe first of all, I'll talk a little bit about who I am and the company I work for. So I'm Jona. I'm the Chief Revenue Officer at openthebox. We provide data on 2 million plus Belgian companies and persons. We believe that we can offer the fastest way to insight on a company or market. So whether you are looking into a company that you've heard from through your network or through whatever source, and you want to benchmark them, that's something you can do with openthebox. You can also detect deal opportunities as soon as signals are available in the market. So that means some kind of publication, some kind of news that this company now fits your investment criteria. And then we're already trusted by almost every major bank and some of the Benelux's leading funds. So our website is linked down there as well. But you can also all find me on LinkedIn. I think by now we're already connected with a few of us already. Okay. And then, of course, my guest today, Christopher, I'll let you talk a little bit about yourself and WAD Capital.
Sure. So basically, WAD Capital is born out of my partner Steven Coppens' vision that Europe is at the precipice of a massive succession challenge. We have been sparring partners and sounding boards with Steven and Al for a while now, and decided to mount WAD Capital about a year ago, or at least start structuring the idea about a year ago, with really the sole ambition to fix Europe's succession challenge by putting CEOs in the lead, or aspiring CEOs in the lead of their search, and using data to do it and to identify these deals. And to date, actually, since we started with the first 3 CEOs in July and have been scaling it up, we have about 160 active deal conversations that we're going through. So the message really is that generative deal flow works, and there are plenty of companies that are under the radar and do not want to advertise the fact that they have a succession challenge, that they could be up for an acquisition.
Yeah, I think that's fascinating. I think it's really interesting to see such a well-defined strategy going after the succession issue. And I suppose both that and the data together really helped you reach that amount of deals. Did you know beforehand that the potential would be this big?
So I think the numbers in Europe are really interesting. So on an annualized basis, 450,000 companies in Europe are for succession, 150,000 struggle. Now, we obviously, as a fund, as a structured financial service, we have a very specific set of mandates that we have to abide by, and financial specifications that we abide by, including the 1 to 5 million EBITDA. So it's 1 to 4. And there is a reason behind that strategy as well. But if we apply our set of financial criteria on top of this 150,000 companies, we actually get to 30,000 companies on an annualized basis that are pushing 1 to 5 million EBITDA and 10% EBITDA margin. So these are very healthy businesses that have zero succession plan in place. So from a data perspective, we knew the opportunity was there. In terms of actually implementing the vision and getting and building out the tech stack to do what we've successfully done, I would be dishonest to say that I knew it was going to be as successful as this, but No, pleasantly surprised with the engagement, and actually giving full credit to the data and the data alone is one element, but the person engaging with the potential seller makes a massive difference as well.
Yeah, I think that's definitely something that I don't want to. We're going to talk about data a lot today and its role in deal sourcing, but it's really just in the end, it's just a tool for the investment professional to really.
It's a tool to it's a tool for acceleration. And actually, what we're hearing from the market and the potential sellers that we're engaging with is that thanks to us being able to identify them and engage with them in a very formal yet also friendly manner, where the actual the CEO who is potentially going to buy and run their company is the one engaging with them, it shortens the time to actually start getting to a deal, because we can start, thanks to the data, we can very quickly analyze whether or not a company fits our investment mandate based on the publicly available data.
And I suppose for the seller, already the meeting the person that would actually run the company also builds trust way faster.
100%. Not having to engage with a broker, and with all due respect to that profession, who has as a sole mandate to extract as much money out of the deal for themselves as possible, makes a massive difference. Also, in terms of the depth of conversation that you can go with a potential seller, they actually the biggest surprise, if I go back to the question you were asking just before, so are we surprised that we managed to get this much traction? Yes, somewhat, but the biggest surprise is how open sellers have been. And how willing they have been to share information that in a normal proprietary deal, in a normal non-proprietary deal flow, so inbound deal flow generated typically by brokers, you would not get access to until much later on in the process. So
and I suppose that the data is a big driver there as well, because it allows you to come into a conversation. I mean, again, it's a combination of your strategy and data, but you're probably the first person ever reaching out to them about a potential sale, or much more often.
So in those terms, not necessarily. So we're not always the first person to reach out to, and we have had feedback from potential sellers that we're engaged with today that generally, when a broker contacts them because they've identified, they tend not to engage with them, because they have no clear oversight as to who is going to be running their company. Again, at the end of the day, these are small entities where actually these retiring founders have been in these companies for 30, 40 years. They've, most of the time, and this is a recurring joke that I make with some of our LPs, but most of the times they've spent more time with their company than they have with their own family. And so there is an emotional aspect there where, and again, this is empowered thanks to the data, that you can identify the age of the company, the age of the UBOs, and very quickly identify whether or not they could be a succession issue. Because you can also identify whether that person has family within the capital or working within the company that could maybe be interested to take over the company, and therefore we would prioritize an entity like this lower than one where it would be clear. And the data, this is all thanks to the data, and you add a layer of machine learning on top of that, and the speed at which you can identify potential deals is mind-boggling.
All right, let me then move on to our first trend, and I think this ties in a little bit. It comes down to how do you combine internal and external data throughout the phases of the deal flow. Obviously, when we're talking about spotting trends, it's 99% external data. I'm assuming for you.
Yeah. So yes, and we're using multiple external data sources because benchmarking is a huge one as well. And we also aspire to look at bigger deals within the same sectors, and identify what trends there and what the winners could be. And so when we're using external data, we're looking at, first of all, the publicly available data on these specific entities, but we're also looking at it on a broader market, from a broader market perspective, and running comparative analysis against these things. And because of our, or in spite of our methodology of hiring proven, or not hiring, but partnering with proven seasoned executives and putting them in the seat of an investment manager, we've almost been forced to try and automate as much of that stack ranking and benchmarking with external information. In terms of getting sorry?
Typically what an investment analyst would otherwise take care of, you've had to automate.
Yeah, actually, absolutely. Obviously, we check it with analysts of our own, but a lot of it is automated as you start getting a flywheel effect, because whatever you've picked out on, off, or the discrepancies, because we're looking not just at Belgium, but we're also actually 300 kilometers for the first fund. We've targeted 300 kilometers around Brussels. The reporting standards are different depending on which geography you go to. But that benchmarking becomes really interesting, because what we spotted in some sectors is that some consolidation efforts have already happened in Limitrof countries within our catchment area, but not yet, let's say, in Belgium. And we can very easily start doing some comparative analysis thanks to the publicly available data there and the external data sources. In terms of internal data, again, because we have this proprietary deal flow and generative deal flow, we're generating a lot of internal data in and of itself when we're doing these analysis. But then internal company data, the goal is to get as fast as possible to engaging with a seller to get that internal data. And we've, again, as I said, we've been extremely surprised at the willingness of sellers to share internal balance sheets, even prior to formal engagement letters being signed.
And throughout the process, where obviously your process is a little unique, I think maybe a first question would be, how has the role of an analyst then changed at WAD? Does this become more someone who is already more of in a more classic fund would be already more on the deal team, who is already, like, at that point you're already working on the deal because you're no longer looking for opportunities, you're now checking what the data is telling you, and then more involved on the actual deal flow already?
This is an internal discussion that we're having right now, because actually we're running through our first batch of interns, and as you know, in the world of private equity, internships is a massive stepping stone into this world. Well, it's one I luckily never had to go through. I think I kind of barged into the big door, came in slightly differently. But now to answer your question, it means that the person indeed is a lot more closer to the deal team, but it also creates an additional opportunity when I'm going back to my previous statement, was when you're running these comparative analysis on broader market trends. Indeed, a more junior person can do this, but it also means that you can start spotting opportunity before even it starts happening. So an analyst becomes a lot more empowered to start looking at for potential opportunities. But here we've been doing a lot of we've been trying to empower our CEOs in residence to do a lot of this work themselves, to generate buy-in, because they start really being engaged and married to the process all the way from the investment analysis phase to operational within these companies.
It becomes their baby as well.
Indeed, but it's a tough process, especially for someone who's not used to running through investment processes. There's a lot of a steep learning curve there. When you have been some of our CIRs or CEOs in residence, have managed previously 400 million euro P&Ls within large multinationals, they want to run. They spot an opportunity and they want to hit the ground running. You have to take them one step back, and it's fantastic because they actually, it forces them to screen the market, and they become a sector expert. And we've had that feedback multiple times, again, from potential sellers, that they never thought these guys that they're talking to are as knowledgeable about the industry as they are. So they're doing some of that analyst job, but they have the competencies to do way more. So they understand it from a different perspective.
Okay, that's nice. Yeah, it sounds like your model creates a lot of synergies and positive overflow.
That's what we're trying to do.
Yeah. All right. No, very nice. So, are there cases where, let me put it this way, you already do a lot of pre-vetting of companies. So by the time you enter into a conversation with the company, you typically already know a lot about them. And if there were glaring faults with the company, they wouldn't even enter into that stage, right? So I'm wondering then, is there at any point a situation where you start comparing already what the company has published versus what they are showing you? So again, the internal and the external data there.
Yeah, we try and get to that internal balance sheet comparison as soon as possible. We are doing a lot of or attempting to do a lot of information gathering at the very top of the funnel, but the reporting standards are such that you start spotting trends. Yes, you start seeing. So one anecdote is we were trying to do a EBITDA normalization prior to engaging with the seller, because we thought that in comparison to the turnover, and luckily it was slightly above the publishing curve, but in comparison with the turnover, the EBITDA level was quite low. And what we realized is, thanks to linked entities, so we started looking at, for example, the management company of the current owner and looking at the revenue stream there, seeing how many entities are linked. But these are somewhat manual processes, and starting to do some normalization there to just make sure that it could be in our target. We know how much the CEO is going to be paid prior to entering into the deal, and so we know exactly where we can normalize and when we can't. But again, today, in comparison to how traditional players are doing it and getting that inbound deal flow from the biggest brokers in the market, what we're trying to do is shorten that deal cycle as much as possible and identify whether or not a company is worth engaging with. As soon as we can get the internal balance sheet, we definitely compare it and start running trends. And then as this internal data becomes greater and greater, you start reaching a flywheel effect where you can spot trends even before receiving the internal balance sheet.
And probably you also, because you have this very specific EBITDA range for companies that you're looking at, they share the same problems. You also know very well beforehand what you want to be looking at on the balance sheet, and any kind of due diligence is pretty straightforward because it's usually the same things, and you can probably cross it off. It's very process driven, I think, at that point.
100%. And the biggest mission today is to dismiss companies at the very top of the funnel, and not waste time. We really want to run a very efficient process and with a very lean team. And this part of the search, because we're based on the Stanford Search Fund methodology, this part of the process is really as if we had a team of 13 investment managers running in the field and sourcing deals. So we need to be as efficient as possible.
That's a very good quote. We'll definitely reuse that one. Okay, no, that's very interesting. Now, final question on this trend. Your combination of internal and external data. You say you want to help deal flow go faster, right? Faster time to a deal. This approach in total, how long do you think you're away from your first deals, or have you already made them? And if so, what do you think the time is that you can realize?
We are en route to finalize the first couple of deals by Q1 of 2025.
That's very impressive, I think.
Yeah. So the way that we set up the structure is you have the search phase. So we're incorporated as a Privac in Belgium, and we have capital for the search phase, and every investor in the search phase has a preemptive right to take a portion of the larger fund, and so we call that capital on a need basis to make it as efficient as well for our LPs. We don't want to start charging management fees while we haven't yet generated a deal, and so we're really trying to seek alignment as much as possible, whether it's alignment with our CEOs, whether it's alignment with us and our LPs, and across the board, which is why we've set it up like this. But we'll be most likely calling in the first checks Q1 of 2025, and ramping up. We've had to push some of our CEOs in residence to go back to the drawing board and find other markets, as some of the markets that we had initially anticipated were slightly more consolidated than we thought. But again, the data allows you to go much faster. The biggest conundrum and the biggest discussion, and I can share this internally amongst the GPs, has been how much simpler do you want to make this for these CEOs in residence? Because the data sources are there, our internal system is there in terms of identification. We could actually be screening the entire market on a daily basis and just pick out which companies and flag which companies are interesting to us. But we are there. But because we are trying to generate buy-in and make sure that our CEOs in residence are the sector experts, we don't want to simplify too much. But the data sources are there, and the technology is there to do this extremely efficiently today.
That's crazy. I think if anyone has any questions on this topic, or you want to dive deeper, I'm going to move on now to our second trend. But don't hesitate to hit up our Q&A or our chat. We'll have a section at the end where we cover anything you might want to discuss. All right. Okay. So I think we've just kind of neatly moved into that. I think this is a trend that I see, especially internationally. There are also platforms that are focusing on this entirely. Where private equity funds develop their own sourcing and deal scoring models to actually start proactive deal sourcing or generative deal flow, as you called it earlier. I see some of the leading funds are moving there, and then there are funds like you, very new, very fresh, but immediately adopting this new trend. How do you think the market is going to respond to this? Is this going to become the new normal, or what's your thoughts?
Bold statement, the boldest answer I can give you. I think that it is the only way to fix Europe's succession issue.
Yeah.
And when I was mentioning the pond that we're fishing out of these 30,000 companies, I don't think that people realize just how substantial this is. We're talking about a potential loss just for our segment of 7 trillion euros over the course of the next 10 years that could be wiped off the European GDP if solutions like ours don't exist. So and there is some shame and probably there's a lot of evangelizing that can go around also to potential sellers, and this is where I think part of the advisory role of existing M&A brokers, but also accountants, lawyers, and all of the professional services servicing this cohort of people, to alleviate that shame that it's okay not to have a succession plan, but it's better to act earlier than later. But I don't believe that we can fix Europe's succession challenge without proactive deal sourcing. Because just the mass of companies, the infrastructures are not there today with the traditional brokers to handle this flow. And the pricing models and the business model around the traditional brokering industry just isn't suited for this class of companies. The people selling want to talk to the people buying, and as soon as possible. And not just the people buying, but the people who are going to be running the company. Today, as partners, so Steven, Alan, and myself, we seldom engage with the sellers until our CIRs tell us that, okay, we're getting much closer to a deal. Now let's start talking real factual numbers.
Yeah.
But until that point, it's the CIR who's engaging with the seller, and they're talking about everything to do with the operation of the company. So it's a much more human. It allows, and the proactive deal sourcing allows for a much more human approach to the process. So, as I said, I don't think that Europe can fix its succession challenge. And it's 47% of all SMEs in Europe on the hands of people above the age of 60. And I'll concede 60 today, and I don't want to insult anyone watching, but 60 today isn't what it was 20 years ago. We thankfully we're a much healthier society, but as Europeans, we still have aspirations to start enjoying the fruits of our labor, and so you need generative ways of reaching out to these potential acquisitions in order to fix that. The counter to this, and we've seen this in our deal flow as well, is people had not yet started to think about selling. But thanks to the generative deal flow approach, they're actively thinking about how can their legacy survive. And that's really at WAD Capital what we're truly about, is building on top of the legacy of these exiting founders.
But I think that is also the dream outside of a succession focused strategy. I think it's probably the dream of every fund to reach a seller before they even think about, I mean, revenue. So if we reach a fund before they think about proactive deal sourcing, then we are also winning. They will consider us in the end. Now, of course, you come with money, we ask for money, so it's a different situation. But What I'm trying to say is basically as a fund, especially nowadays, all of the pressure is about assets under management. And you want to return as much value as possible to your LPs. So there's a lot of pressure, I think, on funds to find the right investments at the best price possible. As soon as other funds start using proactive deal sourcing, basically you're going to be in trouble if you don't start doing at least some of your business that way. So I was wondering what your vision is on that. I think aside from your own specific strategy, which is completely, I think you're a unique case because you're completely designed around proactive deal sourcing. But for funds who are looking into it now, I think it's if you're not already doing it, you need to start taking it seriously, because others are, and they might get to deals before you hear it about them through a broker or otherwise through your network.
Yeah, it's a valid point. Indeed, as a fund, you have a mandate to try and return as much of the fund and surpass those. And I, for myself, I have a track record that I need to beat. My past fund having returned 7.5 times MOIC. So on 140 million invested, so that's more than $1 billion returned. Yes, I have even personally, but I know I speak for Steven and Alan. We are very well aware that our mandate is to return, and my personal goal is to surpass those returns. I think the pond is big enough than to be too worried about competition. We are operating on, so we're empowering between 10 to 12 CIRs on a yearly basis. So our first fund will be a close at 100 million, but we're a $1 billion euro initiative. That's the capital that we want to deploy over the course of the next 5 years. I'm not too worried about competition. I think the market still needs to mature a lot before we see funds that are solely operating in a generative deal sourcing capacity. The main reason being that when you're engaging with a seller who most of the time, at least in our segment, haven't necessarily always sought external advice, the process is slightly different and slightly more cumbersome than what traditional funds are used to working with. When a deal is brokered, the broker is doing a lot of the heavy lifting. My dream is that the biggest brokerage houses start having advisory arms that you can call in to advise sellers at specific moments in the deal where it becomes crucial, because I think that will definitely accelerate lesser sophisticated sellers. But again, the biggest key differentiator in a world where every single fund is using generative deal flow, and therefore identifying based on their specific mandates, because every investor has their own special source, is the person who engages the fastest with the seller and who's able to get secure exclusivity with the seller as fast as possible.
I think a lot of trust also comes from being the first. There's this, especially when you're dealing with someone's baby. If you're the first or one of the first, and then of course, I'm not in any way diminishing the role of the person who is actually reaching out, right? It's not just about being first. It's not just a race. Then the person has to have the human touch, understand the market, build rapport with the seller. and that's all the professional doing the actual job and securing that deal. But if you're not first, you're already massively behind.
100%.
Yeah.
100%. I think it's definitely going to be in the most classic sense of the word, and going back to my venture investment days, it's first mover advantage.
Yeah.
And
First believer advantage. I think it feels that way for a seller. Yeah.
Yeah. And this is where data comes in really, really handy, because you can screen a company, see how it's performing against the rest of the market, and against similar examples, even in geographies that are in limits of countries, and decide whether or not you want to pursue that deal. And you only engage when you want to pursue that deal. Will there be bad actors and who and I don't know if anyone here watching who is going to be bouncing, okay, we need to get exclusivities with as many target companies as possible, as fast as possible. But I think there's usually, when your intentions are bad, you get discovered quite quickly and in the market. But absolutely, it will be about being able to identify those deals really early on in the process, and engaging in a thoughtful, human-centric way with these sellers.
Okay, nice. All right, I think that's a nice wrap up for our section on proactive deal sourcing. Then there's another trend, and this is something that you see to varying degrees. It also depends again on your investment strategy. There are tools like Omni, acquired by JP Morgan, that help 400 funds worldwide just track their portfolio. I think most of their funds are more VC focused, so there's a lot more work to be done there. I look at what we have to offer with openthebox, and I look at what you actually need to know about your portfolio. Is this something that you're already looking into? Like, what happens after the deal?
Yeah. This kind of touches on one of the reasons why we are operating the way we do, which is with CEOs in residence, and with a cohort of CEOs in residence that are driving these deals and driving the deal making and deal sourcing, enabled by us, is that we can start discussing proactively during the search phase. And during this phase, which we're estimating to be between 6 and 18 months, is that we can start discussing about portfolio management and ensuring that the same methodologies, the same good practice is implemented within our portfolio companies, and therefore reporting is also streamlined across the portfolio. I think obviously working with CEOs in residence is relatively new, and working with on the bench CEOs is the older way that traditional private equity works. But again, going back to the comment that I was making earlier on about, I don't believe that Europe's succession issue can be fixed unless some methodologies are applied. This also applies to it. So in terms of what we need to report as a fund to our LPs, it's made a lot easier if everyone's on the same page. When you look at traditional, and because we're operating also as a buyout fund, when you look, so we can impose these methodologies post-acquisition. When you look at the traditional process where you're pooling data, and just the sheer volume of human resources required to run fund reporting and management, even with the modern tools, if you can preemptively start agreeing on post-acquisition methodologies, it makes for a much easier reporting. And again, as I said, the goal is to deploy €1 billion over the course of the next 5 years. So we need to be as efficient in our portfolio management as well.
Yeah, especially looking at the EBITDA range of the companies you're going after, that's going to be a lot of portfolio tracking.
Yes.
Yeah. Okay. To what extent do you then rely entirely on internal reporting? Are there other things that you do you also then just use external data points where, you know, as soon as an annual account is published or whatever, that you also just pull in that data because it's maybe just easier?
Yeah, so the way we are operating as value creation plans are done from the minute a deal moves beyond a certain stage. So as we're tracking several deals, and I always remind our CIRs that the art of deal making is ensuring that you've got several deals in the balance at any one time. For them individually. You never know if an acquisition is going to materialize until the ink hits the paper. So the beauty of the generative deal flow is that you can start doing the value creation blueprint pre-acquisition and make sure that you track it and balance it based on other benchmarks. The goal is to do exactly the same thing moving forward. We will keep benchmarking our portfolio companies post-acquisition against similar sets of data, but
Yeah.
as well more advanced, because we have a trajectory, we have a goal as a fund to make sure that obviously these acquisitions mature and hit specific milestones. And we will always be benchmarking these portfolio companies against the publicly available data.
Okay, that's very very interesting. Okay, yeah, I think we've answered this pretty conclusively. We're also 18 minutes away from our time limit. I see a first question has already come in our Q&A. So I think
Is WAD Capital always taking a majority
yeah.
in buyouts with the MPI and a minority, or the other way around? We are structured in a way that we are taking the majority, and the participation of the CIR is part of our stake in the entity. So we have long-term engagements with the MBIs. Because of the way that we are working with a CEO cohort, we elected to actually all be aligned in the same North Star. So our stake and the MBI stake are part of the same one.
Okay.
Until
Nice.
our exit, that is, yeah.
Yeah. All right. How does that? Did you structure that in a particular way for the incentivization of everyone involved?
Yes. Everyone's incentivized. So we, as a GP, are beholden to the same level and same variables as our CEOs and residents. The MBIs can be an investor in the fund. That being said, the goal is for them is not we don't believe that I'm going to answer this in a long-winded way, but I think it might shock a few people, and we definitely had some discussions with some LPs about this. We don't believe that your ability to invest should dictate your management capacity for our MBIs. That is, the buy-in for them comes in during the search phase. So you need to know that a lot of these guys are coming down from 300-400K a year to about 100K a year during the search phase. So that's technically already a 300K investment that they're making. That's a hit that they're taking. If they are to invest, they would be investors in the fund. But the way that they're incentivized is on the upside, just like we are. So with carried interest.
All right. Okay. Okay, we have another one here. What data points are you taking into account for targets?
Sure. So EBITDA range, assets. So how many assets are on the balance sheet? Obviously, cash positions, and capex, which is a massive one for us as well.
Yeah. Is that to already preemptively build like a rudimentary valuation?
Yes.
Yeah.
We before we engage with the seller, we go we already run through a set of valuation, different valuation methodologies, so that before we engage with them, we already know ballpark where we might end up, and how much capital we might need to deploy for that specific acquisition.
So you actually have methods really to do a large part of the valuation before you even get a data room.
Correct. We already know more or less how much an acquisition will cost us before we engage with the seller.
Yeah.
The goal after engagement is to confirm those hypotheses. Now, we don't communicate obviously our valuation to the seller, because if we're off, if we're too high, at the end of the day, it's the art of deal making. So we're not going to pay too much for an acquisition either. But
that would just sending over a valuation is the same as making an offer.
Yes, exactly. Well, it's as if I had called you and said I was going to give you 50K for access to your entire data source.
Yeah, you were? Okay. Okay. So we have two more questions. This one's about the EBITDA range and the reason behind the financial specification, and if you can tell a bit more about this specification.
So there are a set of very specific criteria that the bigger private equity players look at when investing. A succession challenge to date has generally meant that it would be discarded from a traditional private equity investment.
Yeah.
That being said, it's still a red ocean. Anything above 4 million euros in EBITDA is a massive red ocean, and we just don't. When you look at the core competencies of the GP, we don't have. We believe that a lot of our value in terms of what our career paths have been a lot of the value that we have to offer to the to our portfolio companies will be greatly or generate much more substantive returns the lower down the market, because that's where you can really improve a lot of these processes. Seldom will a company below, at least if you're between the 10 to 50% EBITDA margin, seldom will a company of that size already have middle management layers in place. Again, that's something that we come in and professionalize. So we really see ourselves as a platform builder, actually. So we're fishing out of waters where just below the private equity line, above 1 million, because below you have it's just too small, and getting that traction is too risky. The amount of investment you're going to have to put to really and stability issue, exactly, cash flow issues. So yeah, 1 to 5, 1 to 4, sweet spot out of the traditional fishing waters of traditional private equity. I know a lot of family offices are looking into that space also. But usually it's capital deployment. It's not management buy-in in the stricter sense way.
Okay.
I hope that answers the question.
Very, very interesting. Okay, one final question here. Unless if anyone has any more questions, feel free to still add them. We still have a little bit of time here. So, are there any costs, balance sheets, or anything going out on the balance sheet where that you can improve upon and that you might even look for as a data point? Because this is something that we hear a lot. I think I mentioned it to you before, right? If the owner has 4 company Porsches, then you know that is something that you will not keep in the same fashion once you take over.
Yeah. I'm hesitant to answer this question because the easiest answer would be that this data, so the 4 Porsches, you can't see this on a publicly available balance sheet.
Maybe
I'm struggling
are there proxies that you look at?
Sure. You definitely can, and you can also assume that there's a lot of cost. So one of the proxies is to look at the other holdings of the specific founder or UBO. If there are no management entities or structures in place, you can assume that there is a large portion of the balance sheet dedicated to his personal expenses. That's the number one, and the benchmarking is the second one. So how is a similar entity in the same sector with the same specifications looking at it? So anecdotally, so we have a couple of CIRs that have some overlap in their search, and so we needed to come up with an internal process as to determine whether or not a company would be for person A or for person B, depending on the revenue, the portion of revenue dedicated to the specialities of either one of those. That's a very difficult thing to do on a publicly available balance sheet, and you cannot rely on marketing. In some sectors, everyone is doing everything, but actually, when you get an internal balance sheet, you see that everything is 10% of the balance sheet and 90% is still dedicated to their core. And so we're trying to develop some internal screening mechanisms for this, same as we are for normalizations. To get a really good idea of valuation, you need to get to normalization as fast as possible. We've seen companies where the gardener has been on the payroll, the house in Knokke, and all of the expenses for the summer holidays are there. So we've seen it. Some proxies can be used, but obviously the best would be that the best would be that the internal balance sheets become public. I'm not sure. That's why I was smiling before answering the question. I don't know whether that would be beneficial, even for myself. But I think I would definitely love to advocate, if I ever get the chance to advocate for a lowering of revenue declarations. That's the number one, because right now I think it's too high. And then once you're above a certain level, start declaring certain things. And again, going back to what I was saying earlier on, the job of accountants and lawyers in the field, I think from the moment you set up an entity, and obviously I know things were different 30, 40 years ago when a lot of these companies were set up, but you need to start. I've always, any entity that I've set up, I always set it up with in mind that one day it might be sold. And so you need to structure it. Management companies are easy to set up. So I guess one key message would be for anyone running an SME with 1 to 5 million EBITDA, start setting up your management companies and move your internal expenditure to that management company to make it easier to carve out after.
Create a personal vehicle for
yes.
Anything. Yeah, that makes a lot of sense.
Very easy.
Those watching, if you're interested in being acquired, better get on that. One final question, and I think we can answer this together. whether you use openthebox's interface for your research, or do you link with an API to a proprietary tool. I think you have access to both. And I know that you're very driven by your own internal proprietary tool. I'm very proud to support that in the way that we do as well. With I think some data points that we are the only ones to provide better than anyone else. But actually, it would be the first time for me to find out as well to which extent maybe your CIRs also use the platform.
So in our current deal pipeline, the biggest tool that we've used on the openthebox interface has been the spiderweb. We've actually integrated that within our own interface now through your amazing API, and I feel like you guys need to start doing a lot of evangelizing, because again, this is such a nascent market is the business data. And some LPs, when we speak to some LPs in France or Italy or Spain, and we show them the data we have access to, they're like, they can't believe it. And so, and you guys need to accelerate your expansion and get into as many geographies as possible, because
we're working on it.
The way you thought about building this your API and your data mapping is perfect for our use case. So no, but to answer the question, it's a combination of both.
All right, cool. That's a great answer for me. It's a great snippet that we'll be able to use over and over. So thank you, Louis, also for the question. So we've received one question. I think we'll have to cap it after this because we only have 3 minutes left. What impact has the actualized value of land used for operations on the valuation of a company, given that the value of land is often undervalued on the balance sheet? Do you account for this in your valuations? This sounds like it might be a seller or a competitor.
So the model that we are aligning ourselves with, which is the Stanford search fund methodology that has been yielding 34% IRR for the last 30 years. So it's one of the best performing asset classes in the market, is an asset light one. The way that we're structuring all of our deals is to create an opco and a propco. The land value will go part of the propco. We will always be incentivizing sellers to hold on to the propco. What we're interested in is the operation and the business in of itself. And it's a smart way of structuring a deal, actually, if even for a seller, because it guarantees continuous line of revenue above the acquisition capital. But we seldom account for land value or real estate value in our valuations because we carve it out. Either we will incentivize the seller to hold on to it, or we have partnerships with various banks. And if any banks are watching, more than happy to discuss further, because I think, again, 7 trillion needs to be secured over the course of the next 10 years. So plenty of room for financing and refinancing of assets and land. But yeah, we're not, as a fund, we're not dedicating equity to land or real estate, and we will always be carving it out.
Okay. All right. Great. I think that's a great conclusion or a great concluding answer for our Q&A. It was a very fun session. Thank you, Christopher, for being here.
Thank you for having me. Thank you for having me, Christina. I think your name was changed for the day.
yes. I logged into the wrong account and I noticed it about 15 minutes in. So here we are. So I want to conclude again. So data in private equity, very important. It's definitely changing the game. It's been a pleasure to share the stage today with such a forward-thinking fund partner designed entirely around data and proactive deal sourcing. If anyone else has a question about private market data in deal sourcing, feel free to hit me up on LinkedIn or find us on our website. Thank you for joining us all, and we'll see you in the next one.
Thank you. Bye-bye.
Bye.